Yeah. Surprise, a little different than you're used to. Dropping these bars on YouTube, knowledge I introduce you. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the moe, all the Mars on deck. What's going on, everybody? Welcome to this live. So you've already seen the thumbnail and you've seen the title of the video. We're going to talk a little bit about this because today marks the 15-year high in mortgage rates. The average 2-year fixed rate now is at 6.6%. I want to talk a little bit about who this is going to impact the most. I want to talk a little bit about what that actually means in terms of like your monthly payments to your mortgage. And I'm going to share some numbers with you that will be sickening, because even just looking at these numbers right now, I'm like, what's the point? It really does put a spin on it when you start to think about the numbers that are behind this. And look, we find ourselves in a new economic phase. I put in the poll here asking you whether or not you think we will see a fall in interest rates in the next 12 months. I'd love to get your opinion on that. By the time we finish this live, I'll end that poll and share the findings, your votes, your say. But let's really talk a little bit about this, because it is pretty staggering right now, and it's pretty worrying for a lot of people who may be looking at mortgages right now specifically and trying to get onto the property ladder. So look, who is this going to impact the most? First and foremost, this is going to impact first-time buyers. This is going to impact anyone who has a high loan to value. And you don't have to be a first-time buyer necessarily for that. If you've got a mortgage and you've had a mortgage for years, but you've remortgaged and you've released equity from your property, brought up your loan to value, it's going to impact you because the rates are just not going to be as attractive. And it's also going to impact people if they have a really poor credit score. There's maybe some bad stuff in the credit history going on right there. So that's mainly the three groups of people this is going to impact. Now, I do want to just kind of give you an indication in terms of the scope of the issue that we have here. Now, you've heard me speak a number of times on the channel about the number of fixed rate mortgages that are going to come to an end. And at this point in time, this is an outtake from the Enquirer today. It says here, trade body UK Finance estimates 800,000 Brits will need to refinance loans in the second half of this year, the second half which we've just entered right now, and a further 1.6 million in 2024 of a total of nearly 7 million fixed rate mortgages that are outstanding. And the reason why that's important is because it gives you an indication of the problem, the scale of the problem that we're facing here. If 800,000 people are going to be literally coming off their fixed rates this year, many of which are going to be on 1.49%, 2%, really, really low rates, to what is now going to be, if you have a high loan to value, circa 5-6%, is going to be absolutely crazy in terms of the repayment. And I do just want to share a mortgage calculator with you, just to kind of give you an understanding of what the numbers actually look like. And in doing this, I've done this with the aim of addressing this and aiming this to first-time buyers. Honestly, these numbers are pretty worrying, to be honest. So we're hoping that something actually happens, and the poll is an indication of some positivity and some optimism. So what I've done right here is I've just had a look at, if you're a first-time buyer, you wanted to get buy property worth £250,000, you got a 10% deposit, so you're borrowing £225,000, and let's say you're looking at a 30-year term on your mortgage. We're going to go repayment, which is full repayment, and we'll talk about interest only as well, because if you are struggling right now and you're looking at this thinking, look, my mortgage is going to go up massively, one of the things you can do is go on to an interest-only mortgage for a short period of time. And I have to stress, for a short period of time. So we'll talk about that a bit later on. But using the average 2-year fixed rate as of today, which gets us to a 15-year high of 6.6%, these are what the numbers look like. So even with the 10% deposit on a £225,000 mortgage at 6.6%, you are looking at monthly repayments of £1,437. Now, that's a lot of money. And immediately I start to think about how people then pass affordability, because the reality is what the brokers, the mortgage providers are looking for when you apply for a mortgage like this is they're going to be looking at your outgoings versus your income. So if you have 20, £5,000 coming in per month, and I know that that's a lot. I've just plucked a number out of my head there. £5,000 a month. If you've got expenses of £4,500, good luck passing the affordability test for that. Equally, if you have £2,000 coming in every single month and your expenses are 1,500, that's pretty tight. That's really, really tight. And so the conversation we keep having here about making sure that you're paying down as much debt as possible becomes even more important. That car you have on finance, you need to rethink that. Personal loans, you need to rethink about how you're going to structure those to be able to pay those down before you make a kind of application like this, because the lenders are going to factor those in as committed expenses. And the way this typically works is you wanted to borrow £225,000 with a 10% deposit. Well, they may say we're only going to lend you £200,000, which means then you now need a £50,000 deposit. It is huge. It's absolutely huge. So that's the number per month. And I think for a lot of people, I mean, that gives me the bejesus right there. I mean, psychologically for me, a mortgage over £1,000 is just, it's a lot. It's a lot of pressure. It really, really is. And I know this is relative to what you earn, but first time buyers, you'll be looking at this and you'll probably be like, wow, okay, this is a lot. But this is the thing that I really wanted to point out. And looking at this a little bit earlier on, we talk about amortization, the fact that in the early years of your mortgage, you are paying very, very little of your capital down. A lot of the payments are going towards the interest. Look at this number right here. So your mortgage of £225,000 over 30 years is going to cost you £517,147. That means that you have interest, you're paying interest of £292,147 in interest. This is why people get so outraged with banks and the banking system, because essentially this mortgage that they're charging you 6.6% on is essentially a 130% return for the bank on their capital that they lent to you. You tell me how that's sustainable in society today. Now, let's think about this from a wider point of view, right? You buy this house, £225,000, you retire in 30 years' time, okay? You would hope, in order for you to have broken even on this transaction right here, your property has to be valued more than this, more than £517,147. If you're in London, probably yes. If you're in a densely populated area, probably yes. If you're in a rural, quiet town, maybe a place that isn't as, I guess, affluent, will you really be able to make this money? Would you really have a property that is going to be worth this for you to break even on this transaction? And this is precisely why people say it's not worth it, because you are paying £292,000 in interest on a mortgage, giving the bank a 130% return on this transaction. Pardon my French, but that's pretty fucked up. I'm sorry. I mean, that's almost like loan shark territory. But this is the financial system that we operate in, right? And this is why it drives so many people crazy. Capitalism. And you start to ask the question, at what point do we get to this stage where we say, this is unreasonable? Because I'm not being funny, right? You tell me in the chat. You tell me in the chat right now, whether you're watching this live or you're watching this on replay, what would be a good return for a bank for you borrowing £222,000 on a mortgage over 30 years? Are they really entitled to make a 130% return on that? Please, am I nuts? Am I fucking crazy? Am I nuts? Because that's a lot. If you said they made something like, I don't know, 100 grand, 150,000, even 200,000, I could be like, okay, it's a little bit expensive, but 292 grand? Jesus Christ. And you wonder why people work to the bone every single year. And you wonder why people are so frustrated with what's going on right now. because you're paying £1,437 to own a property that, on the face of things, unless you buy in a really affluent or upcoming area, you may not even break even on this transaction. This is so messed up. I come from the industry, but looking at those numbers is pretty staggering. It's pretty fucking scary. It's mad. It's absolutely crazy. And so this is the news today. We're breaking records. We're not breaking good records. We're breaking records though. 15-year high, an average of 6.6% for a 2-year fixed rate mortgage. It's absolutely insane. It's nuts. Cannot believe it. So, what's the poll saying? Let me just end this poll, see what you guys are saying. So what is the verdict? Closer than I thought. 60% of you think no, we will not see rates fall in the next 12 months. 39% of you say yes. If I'm honest, looking at what I'm looking at and speaking to people that I'm speaking to, the next 12 months are going to be brutal. And it does beg the question, what do you do? If you're in a mortgage right now, well, if you're coming to the end of a fixed rate, you haven't got a choice. You've got to go and look for the best rate possible. Because if you go into a standard variable rate, you think 6.6 is bad. Standard variable rates are worse. Standard variable rates are on there at the moment at 7.99%. A standard variable rate that you'll go on to automatically when you come off your fixed deal or your tracker or whatever. Tell me, can someone please tell me how this is not fucking daylight robbery? Honestly. And I come from the banking industry, right? It's loan shark territory. We cannot continue like this. Our society is not sustainable like this. Like, seriously. It's just not sustainable like this. And I have argued that the banks can't help because of shareholders, and that is a legitimate answer. It really, really is. When you start thinking over 130% return for a 30-year mortgage, it's fucking sick. It's sickening to the bone. To the bone. All right, let me just check out what people are saying, because I'm sure I'm not the only one who's going to be disgusted at this. Liquid Gems is just saying here, this is actually the peak of terminal rates. It always surprises to the upside when everyone's expectations are low. Now that everyone's expectations are high, it will surprise to the downside. I hope so, mate. I really do hope so. I'm not as optimistic as you though, because it's all going to hang on inflation. That's going to be the main measure. And you're saying here the reason why this is the peak is because for the first time since the pandemic, the number of full-time employed are starting to fall. The Bank of England won't continue to raise rates in that environment. I disagree wholeheartedly, because they're already telling you if we do not hit the next CPI check-in, they're already signposting. They've been very, very clear that they are going to have to continue pushing. So it will be great to see what happens in hindsight. But I disagree with you on this one, mate. And that's my fear. If we don't see positive movement at the next CPI check, the target is 8.3%. If it comes in above that, they're going to have to continue pushing, unfortunately. And the employment numbers are not going to impact the numbers when it comes to the fact that our food inflation is still 19%. That's the bit that the Bank of England are worried about, because it's entrenched. If they cannot budge that, that's really, really poor. It's why they're having meetings with the bosses of supermarkets to see if they'll put in caps. They've said no. It's the reason why they're meeting with banks saying, look, you're not passing on the savings rates, the increase in savings rates quick enough, because unfortunately, in order for inflation to come down, we need to see a significant drop in spending. And one of the ways in which you can encourage that is by savings rates. So you could be right. I could be right. There isn't a wrong or right answer here. But I think from everything that we're hearing in their monetary policy summary, the language, the tone that is being set there is they're going to keep going. And it is all about what happens on August 3rd from here on out. Oh, my God. Let's have a look at this one. Bought a pizza from the co-op, £5.75. How are people going to afford this? Pizza. Pizza. A co-op. Thank you for this, Meg. Look, I wanted to make this video just because looking at this number earlier this afternoon, I was like, oh my God, like, it's it's not to scare people. It's not try. It's to try and help people see it for what it is. And obviously, people do their own research and form their own opinions. But that's the whole point of having these kind of conversations. Houses are not worth what they have been selling for. Spot on. Yeah. Look, there's a whole nother conversation to be had around uh, the influence of banks on housing prices, because ultimately it's about how much they will borrow they will borrow for these house purchases, right? At the end of the day. um Someone saying here, even crazier savings rate are not at 6.6%. You can get regular savers at 7%, but regular saver is kind of like a cheat. You're not getting the full 7% on all of your money. So it's a nice headline, but it's not the same thing. um Someone saying it is daylight robbery. um this is not a problem of rates, but the overinflated property prices. I would agree with you there for sure as well. I think those two things go hand in hand though, and to a certain extent are a little bit separated. The unfortunate fact is we need the housing market to burst. We need that bubble to burst. When that bursts, then potentially it doesn't matter what the rates are, because it's all about affordability, what you can afford to pay, right? So if the prices collapse, the interest rates could be high, but your monthly payments are going to be much lower. And I'll just demo this very quickly on here actually, because we can have a good look at this. Let's just say that house you wanted to buy for 250 with a 10% deposit actually falls to something like £200,000, right? And now you still have your £25,000 deposit. You're going to be borrowing something like what, £175,000? Look at this number, 1,437 per month, right? Let's just recalculate this. 1,117. So it's about 300 quid difference every single month. Now, I'm not being funny, but no one should stick their nose up at that. So over what, three and a half thousand, £3,600 a year? Big difference. So hopefully we'll see property prices come down and interest rates come down hand in hand, but there will be a massive impact if property prices just basically fall away. And that's not a nice thing to say if you own a property like myself and many other people, because you're then at the behest of what happens in the market and potential negative equities. And this is the fucked up thing about mortgages: the lenders will still come after you for negative equity. I mean, oh my god, don't even get me started, because thinking about it it infuriates you. It really does. What an absolute cheat of a system. Right, let's have a look at this. True, but how much will your currency have devalued in 30 years' time? Rates are still low. Then inflation and real inflation figures are much higher. In a savings account, yes. If you've invested, probably not. But again, with investment, there is still a risk, though. So not a solution for everyone. But why the heck aren't there offset lifetime ISAs? Good question, actually. Good question. Someone would have to build a new product for that. I assume you're talking about an offset mortgage tagged onto a lifetime ISA. I mean, look, functionally, you're using the lifetime ISA for your deposit. So your lifetime ISA disappears once you get the mortgage. So the offset mortgage is basically working with your savings account, right? I don't know how you would functionally make that happen, because you need the lifetime ISA fund for your deposit. So someone would have to create an iteration of a product that will allow you to have money in a tax-free savings account, something similar to a lifetime, for it to work functionally, practically. Someone's saying, unless the unemployment rate goes up, there is no way spending and inflation goes down. I mean, the unemployment number is going to be really important in terms of the economy and GDP as well. So all this stuff is interconnected. It's a web, isn't it, at the end of the day? Disgruntled of London. The other way of looking at it is, would you be happy for a 130% ROI on a 30-year investment? 6% is only 4% more, 4% above the Bank of England's target inflation. That's true. That's very true. I think it's a lot palatable for people to think about it in that way when you think about investing in the market where you're essentially taking a risk. And many people will argue that the banks are taking a risk, and they're taking a risk of default, essentially. So it's almost the same thing, but it's not the same thing. But when you put it like that, that is a flip way of actually looking at it from a personal point of view. If you put money into the market 6% per year, that does, it does demonstrate the power of compounding. But that's also true when you have debt, when you take out debt. your payments, the interest that you pay is compounded over that period of time. And that leads to the conversation of, you know, financial education, understanding that, look, this is the deal that you're striking at the very, very beginning, being responsible with your income and how you're placing money to ensure that even if you can't balance that transaction within your mortgage, you have something else that is working hard for you to put you in a better position later on in life. Financial education is so important, but we miss so much of this conversation from when we're kids. You know, when we're kids, we don't even get taught this kind of stuff. This is the stuff we need to be speaking about in schools to our kids. Split your savings between two accounts so you can have a double return in interest. Some accounts are capped to 5k. Yeah, I mean, I think you're talking about a regular saver there. That is true, but you've got the cap, and again, you're not getting the 7%. So, for example, if you've got a regular saving with 7%, you're not getting 7% on all of your money. You're only getting 7% on the first installment that you pay into the account. Because if your 7% is that right, so it's 7% for the year, but they're going to allow you to pay in contributions every single month as a regular saver, maximum up to £500. I haven't done the maths, but let's just say it's something like, I don't know, £200, right, or £300, whatever, right? The first £300 you pay in is going to get the full 7% because he's going to be in there for the full 12 months. The second one isn't going to get the full 7%. It's going to get a proportion of 7%, an 11th of 7%, because it's only going to be in there for 11 months. And then you get that all the way through to the point where the last payment that you pay into the regular saver on month 12 is going to get a fraction of the 7% because you're not depositing all of your money in one go, because they don't allow you to do that under a regular saver. But you can open two accounts to try and take advantage of the different rates around you. There is an argument as to whether or not it's worthwhile just going for something like, I don't know, a 5% fixed rate where you know over 12 months, this is the rate I'm going to get. Mathematically, you're probably going to end up in a better place, although I haven't done the maths. So that might be a video. That might be an exercise that we actually do live. If house prices go down, couldn't interest rates just go even higher? It will depend on inflation. It is possible. It is possible. To be honest, I wouldn't like to see property prices go down and then interest rates go higher, because in order for the property market to truly burst, it's probably going to happen because of interest rates. So you would like to think, okay, if interest had got to the point where it had a real material impact where property prices sink massively, you would like to think that interest rates will come down shortly after. But who knows? I mean, the world works in very, very mysterious ways. And you think this is just straightforward stuff, but a lot of the time it's not. To us, hey Pete, BRICS are creating a gold-backed currency. Can you discuss your views on this, please? I think, and many people are not going to like this, but I talked about this when I did the video about the USD. BRICS is a massive, massive risk to the US. It's a threat to the US. It's a threat to Western economy. But them creating a currency that is gold-backed is basically going to be the opposite to our financial system right now. Our financial system is unsustainable because it's built on debt. It's built on debt. The central banks can literally just turn on the printing machine and just go print money. You're not going to be able to do that when your currency is backed with gold or backed or pegged to gold. You can't do that because the value of gold goes up, the value of your currency goes up. If the value of gold comes down, then the value of your currency also comes down, right? You just can't you can't turn on the printer. And I think to a certain extent, that would be good news as a financial system. I don't know that in modern history right now, because if you think about the agreement with the Saudis, that was what? Nixon days. Ever since back then, we've been in this monetary fiscal world where you can just print money. I don't think over the last 40 years we've seen a system where we have a currency pegged to gold in the Western society. So what does that actually do? What does that mean for, I don't know, investment structures? What does that mean for our debt system currently? I'm not clever enough to even be able to kind of speak on that without really doing a little bit of reading on it. But them doing that is going to change the game for a lot of people. It's going to make the price of gold rocket, I would imagine. but they are a serious threat. And if Saudi Arabia join them, there's a list of other companies that are looking to join them right now. I think at some point the West will be the whipping boys going to them for favors, going to them for partnerships. Because if you think about it, right, Brazil, maybe not Brazil, but if you think about India, their economic growth has been mad, mad, huge. Maybe not Russia, but China, economic growth has been huge. If they don't overtake the States in the next 10 years, I'll be seriously surprised. And they would have done it, bearing in mind what's going on with Taiwan right now, they would have done it without firing a shot. Pretty mad. And yes, we can argue the information they always, they do stuff their own way, and it's not always verifiable what they do. But I do think Brexit is going to be a big threat to the way we do things in the Western world, and potentially will represent a big shift in the way we do things moving forward. Pete, what would you have changed then if not get where you are? Okay, sorry. What would you have changed then to not get where we are now, and what would you change now? Look, it's really, really difficult, mate. I mean, I'm not a politician for a reason, right? If you think back to the catalyst and the reason why we're in this mess when it comes to inflation, a large part of that is due down to the fact that so much money was printed during COVID. Would you have done nothing? Can you imagine? Can you imagine what would happen if nothing was done? If the government didn't print money, what do you think would have happened? There would have been an outcry, outrage. So they printed money. This is where we find ourselves. The war in Ukraine hasn't helped. The fact that the Bank of England has dithered hasn't helped. The fact that we've kept interest rates so low for so long hasn't helped. Would I've changed printing money? I don't know, mate. I really don't know. What would I change now? I mean, look, there were lots of articles today talking about, and it's certainly this week, I've seen plenty of articles talking about pay rises. Now, as messed up as this is going to sound, pay rises, bad for inflation. You got more money trickling into the system. You need money out of the system. So when Andrew Bailey says, don't ask for a pay rise, he gets stick for it. He's talking about it from an economic point of view. If you wanted to fix this situation, and like I said, I'm not a politician, I'm not even smart enough to be in the rooms with these guys, you'd have to make the very, very difficult calls. No pay rises across the board. Keep it low. You have to reduce spending, which they've already kind of bought in and signposted through the last few budgets. You'll do that. Those are hugely unpalatable. I'll tell you what I would do, 100% though, is I would find a way to tax wealth. I would find a way to tax all the properties in London that are owned by fucking Russian oligarchs and tax the shit out of them. That's what I would do. If you don't like it, hey, listen, you can leave. But this is what needs to happen for the benefit of the people. Because everything I've just mentioned beforehand, the majority feel the pain there. If you flip it on its head and say you just want the wealthier people to just pay a little bit more, and I'm not saying taxing their income, taxing their assets. Yeah, they're going to moan, they're going to complain, some of them might leave, but actually for those that don't, the contribution you'll get from them would be huge, would be massive. It will make a lot of difference to the majority. The way we're currently operating, we can't continue like this. And capitalism got us here. So what does that say for the system? Very unpalatable choices. The problem is, do we have politicians with the nerve, with the gumption, with the courage to do what is necessary? I don't know. Yeah, so I was looking at swap rates today. I mean, swap rates are interesting. They're constantly moving as well. And you also have things like the LIBOR rates and stuff like that, the rates at which banks actually lend to each other. And funny enough, that's actually higher than the base rate right now. And like I said, with all of these things, they're passing on the cost of debt to consumers, essentially. Someone's just saying here, appreciate your opinions on BRICS. I think there are 30 countries that want to join now or have expressed an interest. Most of them are resource-rich countries. Listen, if if you get all of Africa joining BRICS, mate, listen, there is so much turmoil going on. Like, and it's been very, very encouraging to see that the new leaders in Africa are kind of like, we're not going to continue to do this and continue to do business under the terms of European powers anymore. And it's been interesting to watch those kind of developments recently. Printing the money and spending it on real products and services would have made a massive difference. All the fraud, not only the waste, uh, but knocks confidence in the system. That's very, very true. I mean, a lot of, if you think about it, it was very inefficient when they printed money for COVID, because even wealthy people got it. And wealthy people don't necessarily spend money, because what they basically do is they go and stack the cash in investments and properties. So what that basically does is it inflates asset prices. So that money that you're printing necessarily isn't going to the people who will actually go and put it back into the economy to recycle the money into to help other people. No, for that portion of money that's gone to very wealthy people, it's surplus to their income anyway. They've got enough income anyway in assets which generate income for them. They're just looking at everything and it's okay, cool. We'll throw this into more assets, increase their asset prices. It's mad. It's the reason why we saw so much property, like property and stock market growth through the pandemic, because people were sat there with extra cash. And what do? The smart people go and invest in the market. Someone's saying it. Bank of England needs to make needs to make you poor. That's their way at the moment. No pay rises for you plebs. Unfortunately, there are economic reasons behind it. It's just so freaking. It's draconian. It really, really is. And we need to think about how we tax more efficiently at the top end. We just have to, because we can't continue like this. I'd be interested to hear your take on what causes more mortgage crisis or the rental crisis, both the pending disaster for so many people. Take your on what's your. I'm trying to make sense of what you're saying here, Tarvin. 1 second. And what causes the mortgage crisis or the renters crisis? Look, mortgage crisis, it's a combination of things, really. Inflation will have a massive impact because of interest rates, right? But you're also going to be having to you're going to have an issue when property prices are way too high, because the combination of those two things, it's not a good combination. It's not a good mix. And so you're always going to have issues. But if you have lower interest rates where people can still just about afford or comfortably afford a more expensive house, it's still more palatable than high interest rates being offered in the first place. So interest rates are the big concern right now, and that's being driven by inflation. And the renters crisis, I mean, if you're talking about, the fact that landlords at the moment, for a lot of them, it's not profitable, and passing that on to renters, if interest rates go up, mortgages go up, landlords have to pay more rent. It has to be passed on, because at the end of the day, they treat it as a business. In any business that you buy products or services from, if they see their costs go up, they pass that cost on to you. It's exactly the same thing. And so, the primary drivers for me, I think, interest rates, inflation. If we can get those under control, we should be okay. I mean, but it's just a mess, mate. It's so depressing talking about this kind of stuff. It really, really is. Like, give us some good news. Some good news, silver lining, something that we could actually be glad and merry and happy about, right? Where we can actually come on a live like this, we could have a beer and just toast to like something good. I mean, I want something like that. I mean, oh my days. Seriously. It's I'm in a major bind. I have to choose between a 2-year fix at 5.98% or go on a tracker at 5.15 at the moment. I have the cash to absorb a tracker. What would that be a smart move? Potentially. It depends entirely on what you think is going to happen to interest rates. I personally, so this isn't advice, but I personally feel as though, based on what we're hearing, based on what we're seeing, we're going to see interest rates continue to rise. Certainly, I think we'll see an interest rate rise on August 3rd if we don't hit our CPI number, 8.3%. I mean, look, let me just bring you into this as well, okay? Because this is important that I share this as well for you guys. So let me just find this. So we know what we're aiming at. And like I said, these things do change. They change all the time. Their targets, their forecasts. So they change all of the time. And in fact, since the last time I looked at this with you guys, it's changed yet again. But have a look at this right here. Okay. So inflation number. So Q3. So the next quarter we go into, we're looking at inflation. The target that they've set, the forecast is 5.8%. The next CPI check, we need it to be at 8.3. So the question is, yes, wholesale gas prices, energy prices have come down. That's going to start filtering through now. But we still got food inflation at 19%. And we've still got this real sticky element to inflation. Is that likely to improve? The supermarket bosses said, no, we're not going to have any price caps on the price of food. And the reason why they did that is because when they measure CPI, they measure a basket of goods like bread, water, milk, fruit, right? So by getting the supermarket bosses to agree, okay, we're capped the price of bread, it allows them to artificially influence the next CPI inflation number. But supermarket bosses have said no. And to be honest, I don't necessarily disagree with the reasons why they've said no. You know, if you think about the energy prices and all of this help that we've had through energy price reliefs and all this kind of stuff, the businesses had nothing. They had to deal with that, right? So they said no to that. So if you believe that we can hit 8.3 potentially, and in Q3 we can hit 5.8%, which is a big drop, a really big drop, then a tracker could be worthwhile going into. It all depends on whether you think we're going to see inflation hit the forecasts that they're saying here. I mean, this was 5.3, like literally last week or the week and a half ago. The last time I looked at this, 5.3, it's now 5.8. So it's constantly moving. It tells you that they're not really too sure what's going on. So it's moving all of the time. So in the next 12 months, if you're going to go onto a tracker, you need to fast forward to Q3 2024. Well, they're saying in Q2 24, we're going to get to 2%. If you believe that's going to happen, a tracker might be worthwhile. But if you believe, you honestly believe, it's a pretty tall order, I don't think so, then I think a fixed rate is possibly going to be the best thing for you, mate. Because the more we miss our target, let's not get this twisted. The Bank of England has to get inflation to 2%. That is their obsession. That is their role. That's the only thing they care about. For as long as it's above 2%, they will continue going with interest rates. Andrew Bailey has said it. Jeremy Hunt has said it. It's there in written form in their last monetary policy summary. If we continue to see pressures on inflation, we will continue to push rates. They are saying it loud and clear. So it's a really difficult situation, and it is a bind, mate. It really is. But it's all going to come down to what you think is going to happen in the next 12 months or so, or in the next 2 years being offered to you on this fixed rate mortgage. It's a difficult one, mate. I hope that helps. I know I can't give you direct advice, unfortunately. I mean, you speak to, even if you went and spoke to a mortgage advisor, they don't know what's coming down the track. And so they can say, look, these are what the numbers are going to look like, so on and so forth. But ultimately, it's still going to be your decision. It's a difficult one, mate. Someone just saying, I feel like a lot of people, people's money inflow might be too jacked to go to other providers. I think they're going to have to stick with their current provider. My credit score is destroyed. You know, you do have the issue with mortgage prisoners, people that just can't move, and those people on standard variable rates. Now, I was on Sky, 3 weeks ago or something like that, talking about the new interventions that the government announced. I mean, what a load of nonsense. You didn't announce anything really that was new. Right? If anything, I would have loved to have seen some help for people who are mortgage prisoners, who basically may have been made redundant. They haven't got the income right now, but they're coming off their fixed rate and they're going into a standard variable of 7.9% plus. you're decimating their income doing that. The government should step in and say, listen, if you have customers within this client type, this archetype, you need to make sure that when they're coming off their fixed rate, they go onto something that isn't your standard variable rate, where you're charging 7.9% plus to destroy their income, and potentially meaning that these people are going to have to basically sell their freaking homes. This is what I'm saying. Like, capitalism is great on one hand, but where's the compassion for people and the care for people, right? And capitalism, what compassion? What care? It's broken. It really, really is. It's completely broken. Inflation is over 8%. That's that 517,000 total mortgage isn't the return on investment at all. Just as wages, they need to charge over inflation to stand still. I would disagree with you a little bit there as well, because effectively on that one bit piece of business, and look, you can talk about what the cost of inflation is for a mortgage product. That's all priced into the rates that they're basically giving you. So it is a 130% return on investment for that mortgage specifically, right? So you're borrowing £225,000, but you're paying back 292,000. Inflation. What could the inflationary cost for business be? I mean, even if you take the target 2%, 4%, okay, that's fine, right? But it's still a 130% return on investment. All right, okay, you've not accounted for cost and fees and all that kind of stuff. It's still a pretty big profit margin, and it's a massive cost to the individual taking out the mortgage. I know that this is how mortgages work, and this is the industry that that I've worked in 15 years, but I don't necessarily agree with that element to it. I mean, seriously, £292,000 profit on a £225,000 mortgage. How can we sit here and even try to justify that kind of cost? Inflation or not inflation? There's an element where you start thinking about, actually, maybe it's just a little bit of greed. But that's how we do business. That's the cost of business, right? And yeah, shareholders, and this is why it's so messed up, because the banks have shareholders, and the shareholders are reliant on the profits of the bank for pensions, for all kinds of stuff, for their services that they use the bank for. It's all intertwined. This whole too big to fail. We're stuck. We're in a system that is so messed up that to change it is just too painful. It's too catastrophic to even think about changing it to a degree that it's going to really matter and make a huge difference. And it's okay if you're in the system making a ton of money, but for what about for all of those that aren't? For the millions of people who aren't, who for the majority are not. And that's why I get people's frustration when they talk about how unfair the banking system is. And they talk about, let the bankers suffer. I get it. I do 100% get it. I also see it from an industry insider's point of view. I've worked here for 15 years, so I know how it works in the background. But at the same time, this is why it clashes with me. It really, really does. It really, really does. And it's part of the reasons why I do what I do now, because to a certain extent, you have to be accepting that this is how it works, and you have to learn how to play the system. It's pretty messed up. Someone's just saying here, I think we need a full government inquiry to conclude in 6 years. Government inquiry. What do you think that's going to find, though, mate? I mean, it's that puts a lot of faith and trust in the people who are going to carry out the investigation, the inquiry, and hoping that they'll recommend something that will be tangible. Oh my God. My baby took his first steps yesterday, so smashing news. That is good news, Taran. Thank you very much for that, buddy. And congratulations as well, mate. Two Wallace is saying here, buy-to-let mortgages are fixed for short periods and they pass on cost quick. Also, renters reform bill coming in possibly ending Section 21 could say renters crisis first, then mortgages. Both will be bloody. Yes, I would agree with that as well. I'm coming from Argentina, Pete. If you capped food prices, then supermarkets will increase other products to balance their profits. That is very, very true. And what happened in the 70s when they did this, I think it was under Thatcher, you then had food shortages. They're like, oh, are you going to cap these? We're not going to bring these in. And then that makes the problem even freaking worse, and actually makes inflation worse, because when you have a short supply, prices go up. So that is inflationary. It's a really, really messed up way of looking at things. What's your prediction for the next 5 years? Oh, mate, listen, if I had a crystal, listen, I wish I had a DeLorean right now. And this is a Back to the Future reference for those of you who don't know. Great film, Michael J. Fox. If I had a DeLorean, I could go jump in right now and go 5 years into the future and come back. Trust me, we'd all be trillionaires. I mean, my hope is that we'll start to see interest rates level off way before then. I'm hoping we'd start to level off around about 3 years' time. And I'm hoping that we'll start to see some economic growth. And I mean, the markets will do what the markets do, but I think in 3 years' time, we'll see the markets come out of, hopefully, what is going to be a dip into a really nice growth phase. That's my hope for the next 5 years. It's a long enough time for that to happen. I hope it happens quicker. But yeah, I don't know, we've got to vote in Labour, I guess. And I hate to say that. We need to vote in a new government. And I've said it before. Whether it's Labour, Lib Dems, Green Party, I don't necessarily believe that any of them have a clue what they're doing or have any ideas of how to fix this. I hope that I'm wrong, because I truly believe, regardless of who's in office, we have to give them our full support, because if they get it right, the majority of us tend to benefit. If they get it wrong, those fuckers are going to be okay, but we're going to suffer. Ordinary people will suffer. The politicians will be fine. They've got their nice, great big wages and their freaking homes and all this kind of stuff. And, inflation is not going to impact them, but it's going to impact everybody else. And so this is where politics maybe doesn't work, having a system where there are two main parties. Same could be said in the States. It just feels like it doesn't work, because it's either here or there. And then you're picking the best out of a bad bunch. It's like, we need more options. We need more voices. We need more ideas. And I hope we get them. I really, really do. All right, okay. Look, I'm looking at the comments right here. Guys, do me a favor. There are 147 of you on here right now, but at the moment we've got 34 likes. Now, I say this all the time. It takes you 1 second to do it, but I think that we've had a really interesting and important conversation here today. And just by tapping that like button, what happens is, when this live finishes, YouTube will look at it and be like, oh, people actually enjoyed it. They stuck around, they watched, they interacted, they commented. And what they will then basically do is they will recommend to people like you who may need to see this and maybe pick up a few nuggets. So it literally takes about a second or so for you to do it. But if we can get those likes way up to about 80, 90, that will be absolutely amazing. It will really, really help the channel as well. I don't always like to be this negative when I do lives like this, but it's just one of those things where it's like, it stares you in the face sometimes, and it frustrates you, right? And you can't help but feel like that sometimes. You feel like, a bit disenfranchised and stuff. And we need radical change at the end of the day. And this isn't a political channel at all, but politics does impact our personal economies. It impacts our country's economy. It impacts our personal pockets, because everything is interlinked and intertwined. And I hope that we get something right over the next year or so, because this is like the precipice, a very important junction. If we don't get things right now, there'll be pain later on. We're back in territories with interest rates from 15 years ago. I mean, it's pretty staggering. And where it could go, it's pretty scary. It's terrifying. And people will say, yeah, we've been here before in the 70s, but it was very, very different in the 70s. Yes, you may have had interest rates in the double figures, but house prices were still a fraction. They weren't as large of a multiple when you compare your income. So it was still a little bit more achievable back then. And that isn't to downplay the plight of boomers or anything like that. It isn't. I'm just saying it's a very different place right now. I mean, I'm 43. I cannot imagine how difficult it is if you're 20 years old right now, looking at the property ladder for the first time, thinking, what the fuck am I going to do? How am I going to do this? I mean, just the anxiety You have so many pressures. Social media telling you X, Y, Z. Like it's mad. It's absolutely crazy. Now, listen, my hats off to millennials and Gen Zers and anyone who's in their 20s and early 30s right now. My hats off to you, because your challenges are way different to what I ever could have imagined, and I can't imagine the kind of pressure that you guys are under. And we need change. We need a radical change in our system. It isn't sustainable. It's not working, and we can't carry on as if it is going to continue to work. We just can't. I mean, you think about the fact that people are taking 4.6 billion out in savings in May. How is that going to help inflation? That in itself is inflationary, because you're taking your money from savings because you have to use it to tie yourself over. People are having to take money out of their, bank of mum and dad to help their kids get on the poverty ladder, to help their kids pay rent. It's pretty messed up. It's pretty messed up. And whilst we may say, well, we didn't know how we're going to get here, I think I would disagree a little bit. If we had good people at the wheel who understood what was going on, and we had smart people who weren't necessarily too concerned about politics and, I guess, saying the right things and not doing the right things, I think a lot of this could have been avoided. But maybe that's just wishful thinking. It's hard, man. And I speak to people every single day who are just struggling, just lost, and uh, it's horrible, mate. It's horrible. Anyway, someone just saying here, you have a DeLorean. You can go back 10 years and make £10,000 investment in one thing. What would it be? Well, if I could, you guys know that I love Tesla. I would have thrown a ton of money in Tesla, even with the recent dips. That would have literally just been life changing. That's the one company I would have picked, because I remember, even in 2015, talking about Tesla. The other thing that I would have done, so this is dating back to my Canadian Wolf days, in 2013, Bitcoin. And I remember me and my mate Ashley talking about Bitcoin on the 50th floor, one kind of the square. And he was like, "Oh, there's this new thing out. It's Bitcoin." I'm sure it was like £1 or something, a Bitcoin at that point. Like, I don't care what the crashes are doing. I haven't been tracking Bitcoin or anything. I think Bitcoin's what? Where's Bitcoin right now? Let's have a look. Where is Bitcoin? Bitcoin price. If you know in the comments, let me know in the comments. What is the Bitcoin price right now? Search. There we go. No, that's dirhams. I don't want it in dirhams. Why have I got it in dirhams? Let's go pounds. British pounds, or even if we go USD. Where is it? GPP. 23,000. Talk about putting 10 grand back in 2013. I mean, wow, that in Tesla. Sheesh. Take me back right now. That's what I'd be doing. But hey, we can't do that right now, but that's what I would have done if I was smarter back then. Thank you, Wallace. I instantly like every video. Didn't even need to hear a word. You are going to drop knowledge bombs. Cheers, buddy. Thank you very, very much. We're still at 65, guys. If we can get it to like 60, I mean, really, to be honest, based on the amount of viewers that we have live right now, I wouldn't say it's too much of a stretch to actually get it to 100, because that will put us in triple figures, and it will send a pretty clear message to the YouTube algorithm. But I do know that people get annoyed when YouTubers ask for likes, and look, the way I put it is this: it takes you a second to do it, and it's just a way of kind of giving the thumbs up for the conversation that we're having here. Especially if you find value from it, and even if you disagree, right? You may have picked up something, or maybe you might think, "Oh, you have no idea what you're talking about, Pete." That's also fine. I'm not the Ayatollah. I don't profess to be right 100% of the time. What I try and do is at least share a bit of my experience from 15 years working in the banking and financial services industry, wealth management specifically, over the last 8-9 years, to try and break things down and have conversations that hopefully empower your choices and your way of thinking. Not because I want to influence you to go a certain way, but because I want you to make the best decision based on information that is out there. And if I can give you a starting point to do further research, for me, that's a big tick in the box. It's a massive, massive win. And so that's what I try to accomplish here. And, if you do enjoy it, giving a little like is a huge way of saying, yeah, great, Pete, we enjoy this, and please do more, essentially. But I won't press too much. We'll see. We're now at 71. We've got 160 people on right now. So look, 100 likes versus 160 viewers. It's a pretty nice ratio. That's what I'm going to say. Right, let's have a look at this one here. Someone's saying it is not essential to know when the market will go down. The important thing is what you do when it does. Very, very true. Look, we don't know when the market is going to go down. It's like wishing for a crystal ball, right? And that's why, a lot of the fundamentals when we talk about investing is so important. Having a goal, timeline, how much you're looking to invest, the risk that you're willing to take, all that kind of stuff matters, because if you can set that right and you're investing on a regular basis, so you're compound averaging into the market, it's huge, the benefit that it basically gives you. It's massive, and it can be life changing, especially when you look at it over that 20-30 year time horizon, potentially. So yeah, it's not when the markets crash. It's not about time in the market. It's about time in the market. It's about that participation in the market. Someone's just saying here, Spencer, thank you. Click the like button, people. I don't get it. You want to watch, but you won't click the like button. Come on, pull the choke out. Thank you, mate. Thank you for the reminder. Thank you for the encouragement as well. Yeah, someone's saying about 31,000 USD for Bitcoin, about 23,636 pounds per coin. It's saying here in GBP. Someone's just saying it. I think there might be a follow up to this, Rascal. I haven't seen it just yet. As someone who wants to follow in his parents' steps into property, in case you're probably typing a follow up to this here. So we're like Donkey and Shrek. Are we there yet with the rates? Yeah, that is very, very true, mate. You know what? Listen, we do kind of have these conversations, right? And sometimes it is a little bit doom and gloomy and all that kind of stuff, and it's not necessarily good news. But look, the silver lining for me is the fact that we're having this conversation, and there are 160 people on here watching, trying to be part of this conversation. If I think about the things that I wish that I knew, even 10 years ago, and how having better knowledge, having a better insight into things would have helped me make better decisions, it's invaluable. And we don't get taught any of this in school. So YouTube is a great medium. I was reading something yesterday. Over 50 million YouTube channels. 50 million YouTube channels. And to have 160 people live with me talking about this, paying attention, having conversations in the chat, having dialogue. For me, that's huge. Especially when you put it into context of 50 million YouTube accounts. It's absolutely nuts. And so I think in this space that we've created here in finance YouTube, in having these kind of like raw, open conversations, I think any point of view is welcome. Any point of view is needed, because at the end of the day, what we can't do is we can't have an echo chamber. And like, I've disagreed with some of the points that some people have said here, because I see things a different way. But that doesn't mean that they're wrong. That doesn't mean that their views are completely irrelevant. Absolutely not. And I might even learn from a few things. I mean, I've read comments before where I actually go and have a look at things. I'm like, actually, that's a really good point, and it changes my views a little bit. And that's what this is all about, right? It's about increasing our knowledge, allowing us to make the best decisions possible, at least feeling as though we have the foundations to be able to do so. So let's have a look at this. I wanted to follow the steps of my parents into property investment, as my parents who have a good portfolios with only one house left to be paid off. Is it a good idea to wait it out or just invest elsewhere? Mate, listen, if you've got parents who are already experienced in the property game, they're probably the closest people that you could probably learn from and get some tips from, to be honest, mate, because they've already done what you are anticipating to do. Now, look, there is a downside to that. Your parents may only have a property portfolio, which is great, but it can also be tax inefficient, especially if they've not got it in a special purpose vehicle, especially if they haven't got certain things in place from a financial planning point of view. But I would stay close to them, mate, and just really learn what you can from them. And yeah, obviously, diversify into the stock market, so on and so forth, because it's nice to have different asset classes that you're invested into, because sometimes, especially within the stock market, you'll get better tax advantages than you will do with property. So your tax allowances, in terms of your ISA, amounts that you can invest. You haven't got that in property necessarily. So it's nice to have a balance of the two. But I would suggest that you've got some great people to learn from right there. And Tyrone. I'll come to you in a minute, mate. And I think that that's a really good place to start. So, mate, ask your parents questions, learn as much as you can from them, and basically go from there. Tyrone's just saying right now, watch it in the Tesla. Good man. What have you got, mate? Have you got a 3, an S? What have you got? A Y, an X? I do watch YouTube in mine as well. I watch Netflix in mine a lot when I'm charging the stuff. Question from Wallace. I will give you 50K, but if you accept your worst enemy gets 100K, would you accept the deal? How bad is my enemy? How bad is my enemy? I guess. I don't know. Look, would I accept it? Yes. I mean, because I think at the end of the day, right, you cannot base your decisions on whilst you're watching the competition, right? If you're constantly watching the competition, watching what other people are doing, you're going to have everything just go by you. And the question is, right? Yeah, my worst enemy might get 100K, but what is he going to do with it? I could get 50K, turn it into 100K. So why should I be bothered about my worst enemy? And I think that right there is a really interesting philosophical question. I try not to chase the competition or watch what other people are doing necessarily. Focusing on yourself and controlling what's controllable within your realm is the way I've learned to be the best version of yourself and to be able to progress as far as possible. Elections coming soon. Also, that might pause some investments. Economy slowing down until they see who wins. Yeah, I mean, around the election cycle, where you'll typically see that the markets will kind of slow down, maybe fall a little bit, especially in the States and certainly here in the UK, because there's a lot of uncertainty around, fiscal policy, economic policy as well, with new incumbents into the office coming into power. So I think we'll see a little bit of that as well. And, I think that's an opportunity as well to enter the market and to kind of strategize what you're going to do if you're that way inclined. Someone just saying here, free market capitalism has failed. It can't fix the problems it creates. I would agree with that for sure. What should sellers be doing in the market? Right. Okay, dude, really good question, but I'm not a property expert. I did have Charlie on here from Moving Home with Charlie, and he offered a lot of advice and a lot of tips around what to do if you are a property owner currently looking to sell in this current market. And his predictions were actually quite insightful, to say the least. Really, really insightful, actually, to say the least. I'll show you the thumbnail for it because we went live. When did we go live? We went live on the 24th of June. So if I just share this with you, what you want is this thumbnail right here. So will property crash? That's the one you want. Charlie gives a lot of insights, really, really, really interesting insights. So I suggest go and watch that one, mate. But I'm not a property expert, and I try not to profess or comment on things that aren't really my forte, unfortunately. So yeah. Someone's asking here, slightly unrelated, but when financial people are saying spending and profits are up, but then they don't say anything about units sold, I imagine the volume of stuff bought is down due to price increases. Spending and profits are up, but then they don't talk about the units sold. I imagine the volume of stuff bought is down due to price. I'm a little confused on what you mean, but I'm just thinking this through right now. So I think it really depends on the unit price itself, because if you're selling something that's relatively high ticket, all you need to do at that point is advertise to sell more, right? Whereas with lower unit prices, you still need to sell more, but your profit, for you to make money on high ticket prices, is a lot more. So I don't necessarily think that that's true, because they could they could reduce the price of the units to sell more to raise profits, because that does often work. That's why you have loss leaders in business, right? Because they use that to rope in. So I'm a little confused on what you mean exactly, but I don't necessarily think that that is 100% true 100% of the time, um, because it depends entirely on what's being sold, I would imagine. LISA versus private pension, which one is better if you already have a workplace pension? Thanks, Pete. Look, pros and cons. Lifetime ISA, you can only put £4,000 in there. Your personal pension, private pension, you can pay up to £40,000 in there, but it is depending on how much you earn. So if you look at it from contribution levels, then pensions, number one, immediate win. I think where LISAs come into their own is the fact that you haven't got the issue of accessibility until you're 55 with a lifetime ISA. You can access it any time, but you do have a penalty to pay. So you'll pay 25% of the balance of your ISA, and that could be more than what the 25% contribution from the government turned out to be. So there are circumstances where you'll pay back the government even more, which is their little sneaky way of making a little bit of money out of that. But I think if you do have a workplace pension, as long as you don't need access to the money, I think a workplace pension offers you more, particularly because if you do have something like a matching scheme, it's free money. It's free money from your employer. And if you can, ask the question about a matching, they've got to pay in 3%, you've got to pay in 5%. Some people will say if you go up to 7%, we'll pay in 7%. It's free money. So for me, workplace pensions, right off the bat, are where I typically tell people, look here first. Look at lifetime ISAs later on, because the potential for free money is pretty large, where you don't necessarily have that so much with a lifetime ISA. Yes, you're going to get 25% from the government, but that material increase from, say, 3% from your employer to 4% can be quite significant. Nice one, Tyrone. 2019 Model 3, got introduced to Tesla around 2016, bought shares and sold all last year. Very nice, mate. You would have made a really nice profit as well, actually, if you sold last year. Yeah, Model 3s are great, mate. And they've come such a long way. I'm waiting for the Model 3 facelift that they're rumoring to bring out soon. On just a completely random note, I actually went to drive the new Model S Plaid. Oh my God. It's such a shame they don't make it in right-hand drive. They're only left-hand drives. And I know someone who's picked one up, and I'm like, you've got to be bonkers. I mean, aside from the initial excitement of being able to get into a car like that, I'm telling you, I don't know which one you have, Tyron, whether you got a performance or not, right? My Model S is pretty old. I bought it in 2016. I bought my Model S. Quick, really quick, right? I'm telling you right now, the new Model S Plaid and the Model X Plaid is terrifyingly quick. It is absolutely bonkers. I've watched so many videos of that 0 to 60 acceleration, and I thought people were over exaggerating. It is crazy. It's nuts. If you have the opportunity to just go up to a Tesla warehouse, super whatever workshop, right? Just go to a dealership and ask if you can take one out. It's mad. It's freaking. I mean, the one that I test drove, they limited it at like, I think it was 80, 85. You're there like that. 3 seconds, you're there. It's mad. Oh my God. I wouldn't buy one because I don't necessarily see the value in putting money into that kind of vehicle right now. But dude, whew, it's insane. Go try it if you can. I'm conscious of time, but there's still quite a lot of you on here. So I'm just going to see what else we've got in terms of the chat here. Someone's just saying here, construction costs to build new properties or extensions are sky high. Materials are up. No red diesel allowed on site, and cavity installation building regs are at 150 millimeter from 100 millimeter last year. Pop. Yeah, I mean, there's still the argument that it's still actually, well, yeah, it is still less to build a house, but it's so much more hassle, right? Planning permission, buy land, you got to deal with managing the project, all that kind of stuff. It just puts people off at the end of the day. Right, okay, let's see this. I mean, like, your weekly food bill is more is more, but you're buying less. Oh yeah, yeah, 100%. In that instance, yes, 100%. So essentially, you're paying more for your goods, but you're buying even less. Yes, because in that case, it is essentially unit prices being increased. So they're increasing the cost of things. So if you're really regimented on keeping towards a budget, you have to buy less. So yeah, I like this one from Meg. I have both ISA and pension accounts because I know what to do. Well done. More houses on the market with fewer buyers. Um, it is not the time to tax those with, i.e., 20 plus properties to balance the market. Um, Many people will argue and disagree with you on that one. I would tend to maybe disagree a little bit as well, because if you think about, the fact that you've got 20 plus properties there. I mean, I talked a little bit about, taxing assets, right? That's one of the only ways you can do it. And so the question then becomes, where's the threshold? Where's the threshold? If you do have a government that says, okay, we're going to try and tax assets more, what's the threshold for it? Is it 5? Is it 10? Is it 50? Some people would say actually 50 is way too much. Is it 25? Some people will say actually 25 is still a lot. 20 is still a lot. Um, it's a tough one, right? It's a really, really tough one. But who's going to make that call? Sonny, I didn't get to watch Indiana Jones. Mrs. didn't want to watch it, and I've heard like it's not really that great either. Um, Although it's nostalgia, isn't it? I grew up watching, Indiana Jones and the Temple of Doom, and the last one wasn't great. And so to hear that this one isn't great, I'm kind of like, okay, do I really want to spend 2 hours watching this if it's not going to be great? But a little bit of nostalgia. I want to see Harrison Ford as Indiana Jones with the hat on and the whip. Takes me back a little bit, right? Oh, what's the advice of first time buyer? Should we wait or go for it, mate? Really, I'm going to say what I've said to a lot of people. Just keep your ear to your local property market and try as much as you possibly can to speak to your local estate agents, build a relationship there, pay attention to interest rates, because the reason why you want to pay attention to your local market is if a property comes on the market, it's undervalued, and the sellers are motivated to sell, it gives you an opportunity potentially. So pay attention to what's going on right now. Pay attention to house prices. Just try and soak up as much information as you can, but pay attention to what's going on locally, because you never know. You never know when something might pop up, and it might just be the right decision for you. So that's what I would say for first-time buyers. Nice, 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 nice. I was just reading Tyrone's comment about the long range here. Very, very nice. All right, cool, guys. Look, 1 hour 12. Thank you so much for watching. The likes are at 87. Guys, we must be able to get 13 more. We must be able to get 13 more to get it over to 100. That would be actually record breaking for the channel on a live. To get to 100 likes by the time we end would be record breaking. It really, really would be. So if we can get there, you'll be doing me a massive favor. I'll be forever indebted to you. And hopefully you found value in this as well. But as always, look, again, we have these conversations not to scare people, but to have this conversation in a healthy and interesting way. And at some stage, I would love for any of you to join me and we can have a conversation like this. I have tried it once before. It didn't really go down too well because people didn't want to have the camera on. And if you're going to have these kind of conversation, I think it's important to have the camera on. But I'm going to think about maybe we do that again at some point and see if people do want to come on. In opposed to type in your comment, actually ask the comment. We can have an interaction. We can have a conversation. I'm not the type of person that was there to make you feel small or to make out that you're asking a stupid question. There is no such thing as a stupid question. But I do think that it helps what we're trying to do here. Have a conversation of money, right? That's the whole point. And I think the more we're able to do that and have dialogue in a richer way beyond just the comments, I think that could be really, 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 really interesting. So we'll see if we can make that happen on the next one. People need to be brave, though, I guess. So yeah. Anyway, guys, thank you so much for watching. I will catch you again tomorrow because there is a video out. I saw something today that was so freaking hilarious. It was so hilarious. I'm going to post that tomorrow. Thank you so much, guys. Catch you later.
Yeah. Surprise, a little different than you used to. Dropping these bars on YouTube, knowledge I introduce you. We chasing this money like it's the prize, it's the voodoo. Fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. We got the traders, got the picture with the Bentley in Dubai. Are you dripping in designer looking fly? On the bombardier, sipping on the wine. Broke man, we broke. Where's the fun in being broke? Stocks and bonds get you yo. That's what I'm teaching these folks. I see that smoke, see them choke. Getting coke. While I'm researching these stocks, buying coke. 20 months on the channel, million people taking note. I got a warrant for Buffet. I'm coming for his vote.